Tanner, if you're here, if you could speak up real quick. Hey, man, you getting on? Okay. Oh, I'm sorry. I sent out a text message. You got the same one everybody else did. That should open up Facebook, and it's got the link directly in there, or it's got the phone number directly in there in the call in.
Hello?
Oh, really? Okay. Okay. Let me know when you get in. I'm requesting everybody else mute their phones and microphones for now, but you let me know as soon as you get in. All right, bye. Okay, again, if you're just joining, if I can get you guys to mute your microphones just for the interim, we'll open it up here in a bit. I did hear whoever joined say hello, so whoever you are, hello back to you. Wait for Tanner to join, and then we'll go ahead and officially start. You should now be able to see my screen, which will have Telechart 2000 open. And I'm also streaming my webcam so you guys can open that up. And for whatever reason, if you want to look at me, you can see me. So if you're going to be watching this in a pre-recorded format or recorded format, obviously they don't have that luxury. But I'll give all those instructions here again in here in a second.
Hello, Brother Jimmy.
Hey, man. All right.
Hello.
So can you hear me, Tanner?
Yes, I can.
Awesome. Bluetooth is all charged, right?
Yes, sir.
Okay. All right. So we're going to go ahead and get started. Hey, everybody. Welcome to a recorded broadcast of, well, it's a GoToMeeting for investing the right way. This is a little bit different. I'm asking you guys, if you guys are joining here live with me, I'm hearing a bunch of noise in the background. Please mute your microphones. I'd rather you do it than me do it for you. That way you can unmute yourself whenever you have a question or whenever you want to make a comment. There we go. Whoever did it got considerably quieter, so that's cool. The only person we don't want muted at this particular time is Tanner and myself. So I'm going to go ahead and do an official intro, and we will start. In fact, yeah, made sure I'm recording. Everybody, welcome to the Investing the Right Way show. This is a bit different. We're actually on GoToMeeting right now, in a live scenario with some of the people that watch the show and some of the people that follow along. I've got Tanner somewhere in there in the background. Tanner, say hi to everybody.
Hello, everyone.
If you're watching this in a live format, you should be able to see my desktop, so you should see Telechart 2000 open. You should also see my webcam. So if you're watching live, you can, of course, shrink that down or make that bigger, make it go away completely if you want. If you're watching this in a recorded format, because we are going to air this as a podcast, obviously you don't have that luxury. So sorry for the postage stamp size window that you will be seeing. I want to get started right off the bat by apologizing to somebody. And somebody you probably aren't even thinking. You're probably thinking he's going to apologize to me. No, I'm going to apologize to somebody way more important than you. And before I do that, I need to kind of explain to you what's gone on in the last 24 hours. So yesterday, I was involved in three stocks. I was in three stocks. Tanner and I were in one together, VLO, Valero Energy. and I was involved also with two others, Paychecks, and I don't remember, Comcast. And Tanner called me and he says, "Hey man, VLO just passed by beyond our support level, and I think we probably need to get out. If we're going to follow our rules about getting out at certain points and not blindly hoping that they bounce back, we need to go ahead and get out of this." So I said, okay, we got out of that stock. I then began to browse through the rest of the stocks that were on my watch list, and I was seeing a trend develop. And the trend that was developing, that most of them were going down, and the big boys weren't playing. So the more that you do this, especially if you're looking on the minute chart, you can see, because of volume indicators, when those mutual fund managers are actually playing a stock. You can tell. And it's just learning how to recognize that little detail that will tell you when to get in a stock and when to get out. And what I was seeing is by and large, they weren't playing. That means that they were waiting for something. And I couldn't figure out what it was that they were waiting for, but that was making me a bit nervous. Then the second stock that I had started to slide. There was no volume behind making it slide, which meant the day traders were doing sell-offs. No big boy was weighted behind it to keep it from happening, so it started to slide. It went past a support line, so I had to sell off on it. That left me with one stock. On that particular stock, I did have volume. I could see two large individuals playing this stock from minute to minute. 1 minute, the person who wanted the stock to go up would buy 30,000 shares in 1 minute on a $45 stock. The next minute, 50,000 shares would be sold by the other person who wanted it to go down. And I watched them tit for tat like a ping pong ball match. It just kept going back and forth. Well, seeing all the other stocks slide and watching this battle take place in front of me, I really felt like I had to play it safe and bail. So I got out of it. I'm now in the hole, $150. If you guys will remember, I started with $1,500 and this put me in the hole, $150. Then Tanner called me back. Before the market closed, Tanner called me back and says, "Hey, watching VLO, and it's bounced off its 20-day moving day average. It's 20-day moving average. It's bounced off of it. It has a history of bouncing off the 20-day and going back up. It seldom ever goes below that to the 50. It's bounced off of it on heavy volume." I said, "Tanner, man, I'm seeing too much negativity in the market right now. I just don't feel comfortable going in." He said, "Okay." He hung up the phone. He watched it a few more minutes, and then he bought. Okay? He went ahead and bought himself. After the market closed, he called me back and told me that he got in. I said, why did you tell me you got in? And he says, "Well, you said you didn't want to mess with it, so I didn't push the issue." Okay. Tanner's not a pusher. He's a very polite, patient, respectable individual. And he just didn't want to push me in it, especially if I felt uncomfortable with it. And that makes sense. Well, 20 minutes after that, while I was on the phone with him yet again, you have to understand, Tanner and I talk all day long. It's a good thing that we don't get charged by the minute on our cell phones, or we would be in the hole. So he calls me in that conversation. He gets a text message alert from our Seeking Alpha app, that app that we have on the resources tab. It turns out that Valero Energy had announced an early earnings report. So they were supposed to report their earnings on the 29th of January. They released that information after close of bell last night. And it said that they were projected to do 86 cents per share, but what they instead were going to return around and do within the last quarter was $1.60 to $1.80 per share. They doubled their expectations. And I got I got pissed off. I was mad. I was mad. I was mad for a variety of reasons. And you have to understand that all the stocks that you're seeing on the watch list, 99% of those come from the effort that I put forth in researching those stocks out. Most of the ones that Tanner has played is because I have found them. Tanner, would you
That's right.
Okay. So
That's absolutely right.
here I was, I had done all this work to find Valero to begin with and play this stock. And I got out of it. Tanner goes back into it because he didn't push me. And here he was going to be able to take a windfall profit the next day. I was mad at Tanner. I told him I was mad at him. I was unjustly angry at him. It was very unjustly, but I was mad at him nonetheless. Why? Because we're human. I was also mad at another individual. Now, I already apologized to Tanner. He said he's got broad shoulders and that sort of thing doesn't affect him. But there's somebody else I have to apologize to, and I've got to do it in front of you guys. This is really important. You see, Tanner and I believe that God has called us into this position to do what we're doing, to bless other people, okay? And we believe that this is going to become a ministry, that in 2014, we will, investing the right way, will become a 501c3, whatever that is, a non-for-profit corporation, and become a ministry. And that this $50 fee that I'm charging people for the instant alerts, I'm going to begin to eat that just as soon as I can. Full disclosure, it costs me $15 a month for the website. It costs me $80 a month for podcast distribution, and it costs me $50 a month to do the instant alert. So I'm into this for $150, and whatever the domain name costs me a year, $15 a year to do that. So I'm into this thing for $150+ a month. So I'm just recouping my cost, really, and making a little bit of money right now. But as soon as I can make some money from the investing, I'm going to eat all of those costs and make it available for everybody to be able to join the instant alerts. And for those that are currently paying, your subscription will cease, but your membership will continue. That's the goal. That's the plan. Within the next 6 months, we really believe that's going to happen. So if this is going to become a ministry, and I'm seeing so much frustration getting this thing off the ground, and I'm now in the hole, and some of the people that have followed me are in the hole too, I actually looked at the ceiling and I actually hollered at God, "What the hell do you want out of me?" Those were my words, okay? Full disclosure, being perfectly honest, I think if we're being totally honest with ourselves, people get angry at God. And I was mad at him.
That's true.
I was flat mad. We have Wednesday night service. I went to church. I sat in my sound booth. I didn't hear a word that the speaker had to say for the Bible study. I just brooded over my own stuff. And I actually, after I'd calmed down, I said, "God, I don't understand what you're doing." And instantly, little still voice in the back of my mind, I finally heard it was, "I'm teaching you." So the apology that I have to make is not necessarily to you. The apology that I need to make in front of you, however, is to God. God, I'm sorry. I'm sorry I don't get it sometimes, but I thank you for your patience, and I thank you for your calling. And as I've said before this show started, and I'll say it now, if this is not what you want me to do, I beg you to please pull the plug on it, yank the brake, get me out of this. Now, to you guys listening, Tanner and I prayed that well before we started, and instead of the brake being pulled, we had doors open for us. They gave us a confirmation that this is where we should be. Well, now, let's fast forward to this morning. I woke up this morning expected to see Tanner make triple, quadruple what he invested in, and me very jealous of him, only to discover that because things orchestrated themselves the way that they did, I actually avoided some serious losses. And because VLO announced earnings overnight, Tanner broke even. We're talking the market went down so fast and in such a hurry today that he would not have been able to not lose money if it weren't for them releasing such positive earnings early. Tanner, do you agree with that assessment?
Absolutely. The stock VLO would have tanked just like everything else, because if you were watching the overall stock market, there was a lot of red, a ton of red, and the fact is BLO has been behaving correctly, like what it has in the past. But there's a lot of other stocks that decided they were going to move down to their 50-day or somewhere thereabouts. And so I would have lost a tremendous amount of money in a very, very short period of time.
Instead, you broke even and lost nothing.
That's right. That my only cost, the only costs were the commissions for the trade. So I essentially lost $6, $6 and some change with the option. So, and believe me, I mean, I can tell you some horror stories. I've lost over $600 in a trade before. So there's a reason why the rules are in place, and I have to admit to you that on that trade, I had broken, well, probably 2 or 3 of the rules, and it was all because of emotions, which is what Jimmy's talking about right now. The rules are in place to help us control our emotions, and the fact is that emotions that are unchecked, they will cause us to do a whole lot of things that'll end up ultimately costing you money in your pocketbook. But for the grace of God, and obviously this is one of those situations where the grace of God was evident not only for you, but it was evident for me. Because when I say I broke even, I literally yesterday I bought 3 contracts at $3.66 on a market order. I turned around today and did another market order because it was moving so fast against me, and it did it again. I sold it at $3.66 on the dot. And that's a market order, so that means that the market maker pretty much set the price for me. It wasn't like I put a limit order in. I let the market maker do it, and that's just God. That's God's providence right there. So I'm grateful. I'm grateful to Him that He's looking out for us. And I know that the lessons that are learned, we're learning new lessons every single day, and trying to get that information out to you as quickly as possible, because in all truth, this is the worst market you could possibly learn how to trade in. It has been influenced inappropriately by the Fed, the Federal Reserve, and pretty much they have propped it up, and they've caused the market actually not to behave like what it's supposed to. And so you're learning at the most difficult time, and all I can say is wonderful. It's wonderful news, because it's not always going to be like this. There's going to come a day when you will get into a trade, and instead of staying into it for 1 or 2 days and then having to get out, you're going to stay in a trade, get into a trade at a very good buy point, stay in it for maybe 2 weeks, 3 weeks at the longest, but you're going to see your dollar movement and your profit movement go through the roof. And the whole reason why is because you learned at the most difficult time. So I am so excited for the future, for everyone involved. I'm excited for Jimmy and I as well. I'm excited for the ministry. And our biggest goal is just to empower you as individuals to change your family, not just your family, not just the people who are closest to you, but empower you to be able to put money, to put actual money to work for individuals that you know that otherwise you wouldn't be able to help. And this is the catalyst for being able to do it. So if you're with us and you've been trading, congratulations. You've learned so much at this point in time that you're going to be able to use later on and be able to capitalize on it. So I want to say something for the benefit of everybody, including Jimmy. The biggest thing that we need to do right now is make sure that we lose small by buying right. Okay. So when a stock goes against us, because we bought right, we know exactly when we're going to get out. So we lose small and keep your capital safe from those losses. And so you sit down beforehand and decide, if it goes past this point, I'm out. And call it your break-even point. And then you have to walk away from the stock and say, okay, it doesn't matter what it does after I'm out, I'm out. Because sure enough, you will have the rules in place, and then you'll get out of a stock, and then it'll go down a little ways and then bounce, and then go up beyond where you bought it at, and you could have made a whole lot of money. And that's just playing with your emotions. Instead, use black and white rules, and you eliminate the emotion. And it's going to save you money, especially right now, but it's going to make you a tremendous amount of money on a stock play that's going in your favor, because you'll have the same rules on getting out.
Well, let's talk about, I want to do two things. I want to talk about
Okay.
finding some stop out points for you. And we're going to make that really easy to begin with, because we're only going to look at one stock from here on out. And we're,
Okay.
for the near short term, Tanner and I said, I think we just want to play VLO. We're just going to focus on VLO, and until VLO does something radically different and cause us to go off of it, we're just going to look at one stock. So here's a freebie for you. That's the only stock that we're going to play right now. So if you're not involved in the instant alerts, guess what? I just told you we're going to play for the next 2 weeks unless you see it do something radically different. Okay? We're only going to play one. And we'll just go in with one contract, and then two contracts, and then as many contracts as you want to, until VLO does something different. So we'll use that as our gauge on when to get in and when to get out, how you set those emergency stop out points, and how to see where the right time to buy is. We'll use VLO as the example, brother. But the other thing that I want to focus on real quickly is this morning I put out a video that showed the consolidation of the S&P 500. Did you get a chance, Tanner, to actually watch that?
I did not, as of yet.
But we talked, and you know exactly what I'm
We
talking
talked
about.
about it. Absolutely. Yes.
So if I've got the S&P 500 up, this is the candle from today. And if you take that out, this is the trend line that we had drawn. Okay, and you can see that it's forming a plateau across the top. It's not getting any higher than these points. That meant that somewhere over here something was going to give. And in a particular scenario like this, if we're just looking at one stock, it's always going to fall. So my guess is that we were going to consolidate and fall. The S&P 500 would fall. It did. This is the candle that was produced. It actually fell today, so I actually called that. Yay, Jimmy!
Yay.
Yeah. Our biggest question was this going to be the precursor of a bear market? After looking at the concluding numbers and information from the day, we pretty much don't think so. In fact, we think it's probably going to go up tomorrow. This was just a regular, everyday correction. But if it does this right here for the next couple of days, these little bitty movements throughout the day, not going up higher, not going lower, you can look for this to happen again, another correction about a week from now. And that will keep getting shorter and shorter until something really does happen. So we'll be watching for these trends to develop. Now what I want to do is actually look up VLO. So let's pull up VLO. If you have Telechart on yourself, go ahead and pull that up. Make this go away. Tanner, if you pull this up on your screen so that we can kind of look
Sure.
at I know you're doing this on your phone, but if you could actually pull it up on your computer, VLO, on Telechart.
I've got it up right now.
All right. So we need to draw ourselves some trend lines, and previous trend lines would probably have looked somewhere like this. These are our highs. I probably need to scooch that in just a bit. Try to pass that through as many peaks as possible. Well, we did this little hiccup right here, which changed it, but it's still doing one very important thing. It's encountering this 10-day moving average and bouncing off of it like it's its floor or its support, or if it passes through it, its next stopping point is on this 20-day moving average, which is this yellow line down here. And what you'll see is every time it hit the 20, it stopped and turned around. In this particular candle, it went to its 10-day. On the next candle, it opened up, went up, fell back down, bounced off its 20, came back up. This day used its 10-day. This day used its 20 again. This day used its 20 again. So what we're seeing is VLO likes the 10 and the 20. If you're above the 10, look for the 10-day to become your line of support. And as you're watching that stock, what you're looking for on the minute chart is for it to hit that 10-day, and then look for volume. So let me go to the minute chart, and we'll just look at today. Let me back up so I can see the whole day. Here's our lowest point. And if I could focus in, and it's kind of hard, I get a long candle right there that indicates volume on the bottom, and a long candle on top that moved up 15 cents off of that one candle. That tells me a big boy bought in, and that solidifies this movement up. And, you know, you can see these big long spikes. Let's look at.
You can also tell how strong your trend lines are that you've drawn on your own chart by looking at where the big boys actually turned it around. If they turned it around right on your trend line, then you've got great trend lines.
Right.
If it passes through it, then you look at it and you go, and you start scratching your head and you go, okay, well, maybe my trend line isn't exactly right. And the truth is, it doesn't have to be exactly right. It's more of an art than it is a science. However, if you see this and you see that your trend line corresponds with the 20-day and they're intersecting or very close to intersecting at that moment, and I know you can't necessarily see it on your 1-minute chart unless you go in and you draw lines on it. But if you see it bounce off of that trend line, and especially if it corresponds with a moving average on an uptrending stock, that right there is an excellent buy point, a tremendous buy point. Why? Because you know that the big boys, they don't want it to go below the 20-day moving average. Otherwise, they have to start playing the stock differently themselves.
Yeah.
And they've been playing the stock for a while, using the same type of trend line. And the last thing they want to do is have to go back and go, okay, well, if it goes through that 20-day, well, where's the next stop for it? The next stop is the 50-day. Well, the 50-day is way down there on this stock. So that means that they would have to let it go for a while and lose quite a bit of momentum. And that's really what they're trying to maintain on this stock is momentum. Because every single time it hits the 20-day, it's like, think of a skateboarder. They get on a skateboard and it takes a lot of momentum to get them started, which is a big board going, hey, I'm getting in. That's your momentum to get it started. But then the big boys can stand back after that and periodically put cash in it to keep on maintaining the momentum of the
because these big boys don't have one stock, they're playing 50 or more.
That's right.
So what they do is they get a catalyst going to make the stock move, and then they move. They're off. They leave it. They don't look at it no more. They're off manipulating another stock. They'll come back 2-3 hours later and look at it and see how it's doing. Does it need another kick in the pants? And they'll provide a catalyst. So what I want you to do is, if you guys have your telechart open, I want you to look towards the end of the day on the minute chart, and I want you to find the 3:37 p.m. minute time frame, 3:37 minute time frame. Now, what I want you to notice is that the volume is higher than its average volume, but the candle corresponding above it is significantly longer than the candles around it. It, according to this, It opened at 51.04. It closed at 51.15 in this minute. So in this minute, it moved 11 cents. Here's the only way that can happen. If you look at the candle next to it, which is a red candle, it really didn't move too much. Okay, let's talk about what happened different on those two candles. So at 3:37, we get a long candle with a volume spike, and we know that that's a big boy, and I'll tell you why. And the next minute to the right, which is 3:38, we have a short candle, but also high volume. How come I don't have a long candle associated with its volume going in the opposite direction? Let me see if I can explain why. And Tanner, you pull the brakes on me if I get it wrong. Okay?
Okay.
In order for the big boy to actually move it up, what they have to do is they have to place an order that is above the current rate. So at this minute mark, that stock was $51.04. So he places an order, says, I'm willing to buy it for $51.15, 11 cents more than it's currently being traded for. Well, the market maker's going to take it. He's going to take it. And because there's such a big gap between 51.14 and 51.04, that's where you see the length in the candle. He's intentionally paying more than the stock is worth on that minute time frame so that the candle grows longer. The minute next to it, which is minute 3:38, there's only 1 penny difference. That's people buying it at whatever the current price is at 51.14. They bought it at 51.4, or they sold it for a market order at 51.14. They didn't try to bid it down. They just sold it for whatever the market would bear. That meant it was a very short movement. Conversely, on the previous minute, it was long because somebody bought more than it was worth. Did I get that right, Tanner?
Yeah, and just think about it as, what's it called? It's demand. I know, goodness, my brain just went blank. But think about it as having a surplus of something or having too few of something. So the market maker's standing there and he says, I have this order.
Supply and demand.
Supply, yay, thank you. Sometimes it just doesn't work anymore with these mothballs, but I appreciate that help. It's supply and demand, because what happened is this guy on the previous candle at the 3:37, he said, I want to buy this many shares. So, and maybe it's not just one guy, but there's 55,000 shares. Trading hands, 56,100 shares trading hands in that time period, and the market maker goes, well, I've got to raise the price in order to get people to sell this stock to this person. And so that's what happened in that one. And he placed an order in that, and they bid it up to that mark. Well, in this one, the person selling it he's selling out, but there were enough people who were willing to buy it at that price that it just made such a small candle. So that means that there's more buyers in the market than there are sellers. And that's really what causes that stock to just keep on going up and go up and go up. And that's why it does what I've started calling a wiggle waggle, because whenever you buy into a stock, the first thing it's going to do typically is breathe. And then you're going, oh my word, I just bought this stock and look at what it's doing. It's starting to go against me already. The thing is you have to go back to your question and answer your question. Did I get into this trade at the right time? Number one. And number two, is market tone in my favor? Okay, so do we have a positive market tone? And then your third leg is your fundamentals, or the fundamentals of the company. And then, of course, you have to check earnings. That has to be done no matter what. You have to know when the earnings report is coming out, because let's just give it for an example. if you were in Netflix yesterday on a put play, you would be very, very disappointed with yourself because they announced earnings. Of course, it went through the roof. And so you would have probably lost, if not most or everything, you probably would have lost most of your investment yesterday just simply because you hadn't checked earnings. And so,
meaning they announce what the earnings date is going to be, and you don't want to be in a trade through it. Now, earlier in the week, you and I discussed actually buying a contract of Valero specifically for the purpose of holding it through earnings because we felt it was going to be positive. We call that a speculative play.
That's extremely speculative, and I wouldn't do it with the bank. I would do it with just a portion of your money because just like, for example, another company announced that they had missed earnings by 1 penny the other day, and their stock tanked.
It was crazy.
Yeah, it is. And then turn around and you have another company who says, wow, we made 15 more cents per share, and it goes through the roof. And so you really don't know. It may be positive news, just like it was with Valero, but you don't know how the market is going to interpret the news. Because one thing about the big boys, they do not trade off of news. They just don't. They trade off of rumors. So they'll buy into something just because the rumor is out there that something is getting ready to happen. And they have the luxury of doing it.
And we think that they actually initiate some of those rumors.
They sure do, no question about it. Because every once in a while the truth will come out, and then you go, well, I heard that this was going to happen, and it's completely the opposite. And they're using news, and they're using the news cycle in order to manipulate the human populace, the rest of the population, because they are big. They are so big that they can manipulate the market, but they're not big enough if no one else buys in to make a profit. If that makes any sense. In other words, for every buyer there has to be a seller. So what do? They bid a stock up and make it go very, very, very high, so that other people will go, oh my gosh, look at this, I want to get in on this, and then they'll turn around and sell it. And they've got a whole lot of buyers sitting in there willing to buy it. And they know that because they sold it, it's going down. So they're using the human condition against humans. And what we're doing is we're just simply going, okay, well, they're doing it. They're going to do it no matter what. Because you may have an ethical question that comes up in your mind saying, well, how can this be right? Well, I've had to answer that question because I feel like sometimes I'm just following lockstep with the other people, going, man, I want this stock to tank, you know, and so I know that ultimately is going to cost a whole lot of people a whole lot of money. However, you have to come to the conclusion they are going to do it one way or the other. The big boys are going to do it one way or the other. So why not be an informed public and simply use what the big boys are doing in order to bless your family? I don't know about you, but I have mutual funds in my 401k, and I can't wait until I can get rid of them. But while I am still working a job, I've got to keep them. And now that I have the knowledge that I have, the second we go into a bear market, we're going to send out an instant alert saying, hey, by the way, we're in a bear market. And if you have 401k and you have mutual funds, I can't tell you to do this, but this is what I'm going to do. I'm getting out of all of my stock positions and getting into money markets. I'm going to protect my assets, so that at the end of the bear market, I can turn around and reinvest back into those mutual funds that are holding stocks and not have lost 40% of my assets in the meantime.
Yep.
So just take the knowledge that you're learning, because this knowledge is something that once you have it, and once you have the knowledge sets in order to be able to trade, you're going to be able to trade for the rest of your life and make money using the most wonderful device ever created to create wealth, and that is the stock market. So,
all right, so let's look at VLO, and let's tell them what it is that we're looking to do. So right now, if you look at today, now we believe the market's going to go up tomorrow. Of course, we have to wait for the confirmation for that to happen. Okay, we need the market to return to positive tones. Okay, and so because we don't want to swim upstream, if everything's selling off in the market, we don't want to be in an up play on something, right? Because we're going the opposite direction as the market. I'm looking at the candle for today, and right now on my chart, it looks like it both opened and closed right there just under its 10-day. Is that what you're seeing?
That's exactly right.
So what we're waiting for tomorrow is one of two things to happen. It will go above its 10, okay, and eventually return back to it. When it returns back to it, we're going to be watching it to see, will it stop at the 10 and bounce off of it and go back up, or will it continue through the 10-day, this red line, and go down into the 20-day? When it gets to the 20, is it going to bounce off of it and move back up, or is it going to go through it? So we're looking for one of two things. We're going to go up or down. We don't care which. It's going to go to the 20-day and bounce off, or it'll go up and then come back down to the 10-day and bounce off. When it bounces off of either the 10 or the 20, that's what we're going to buy. Is somebody in the room with you, brother?
Yeah.
Is that Kaylee?
Yeah, it's Kaylee.
Tell her that you're busy. Tell her I said that her daddy is busy.
I'm busy. Okay. Well, you're talking to about 30 people right now, so.
Hi, 30 people.
All right. See you later. All right. Love you, Kaylee.
All right. God help me when my daughter's your daughter's age.
Ain't that the truth?
But
yes, that's what we're looking for. And
all right.
When it bounces, that is the perfect buy point.
And again, we're looking for not only the volume spike. Volume means nothing if the candle's too short, correct?
Yes, and even more important than that is where it happens. The most important thing on your entire display for telecharts is the price as it relates to its trend line. Because the turnaround can look very insignificant, but if it happens right on your 20-day moving average, that has now become extremely significant. So the size of the candle, at least for me, the size of the candle is not as important as the fact that it turned around, and it turned around on volume.
Okay. So what I would do then is I would probably take this tool, my horizontal line tool, and I'm going to drop it right here on my 20, and I'm going to take another one, and I'm going to drop it right on my 10. And what that will allow me to do is whenever I bounce over to the minute chart, I can see where those lines are. So I'll back out here. Now I see both of those lines. So this is my 10-day. This is my 20-day moving average right here, and this is my 10-day. So if it's coming down, I'm looking for it to get close to this and move back up. If that happens, and in particular with VLO, it doesn't hit it. It usually hits it and comes up. It doesn't hit it and ride it all day long. It hits it, and within 15 minutes it moves back up. It may roll on it a little bit, but within 15 minutes it's moved back up. Okay, that's our confirmation, but we don't buy yet. Okay, we've got our confirmation that we've hit it, we've moved up. We verified it with a long volume indicator and hopefully a long candle to go along with it, but we don't buy yet. Yeah, we're going to wait for it to breathe. So in this particular instance, we got our confirmation right here. Okay, and if you're looking at your telechart, since you can't see my screen, brother, I'm looking at 152, 153. At that point, it bounced up. Well, now I know it's always going to come back down. I'm going to let it go up because it's not going to follow a steady pathway up. It's going to move down periodically through that trend. Here's another buy point. And you want to catch it as it's coming down. Why? Because the market maker is going to charge a premium if the stock is moving up. So if you bought moving up here or moving up here, even though it's at the same level, you're going to pay a premium price for it. It's going to cost you more. But if it's moving down, it'll cost you less. So we want to catch it as it's breathing down. Then, as you can see, it moves up. So we got our confirmation here, but we maybe buy here, and this is where it ends up on the end of the day. So now what I want to do is open this up to anybody who wants to further clarify what we've talked about or maybe contribute anything or their own observations or whatever. So at this point in time, free for all. There we go. That was either somebody unmuting their microphone or saying, I'm done with you and leaving. Really, nobody has anything to say. Really. I know some of you.
Well, if nobody's going to ask the question, I want to talk about how do you stop out if it moves against you?
Okay, yeah, that's a good question.
You use the same line of support as your rule as to whether you're going to stop out or not. So you hold it after you buy it, after you've waited for it to breathe, and then you buy in. Let's say that instead of moving up like it did to the 51.24 mark, that it kept on riding that line, because I've watched stocks that have come up off of support and gone way up, and then come all the way back down to support and bounced off of it again, and then way up, and then back down on and hit support again. And it's done this all within an hour and a half, of time. And so every single time it starts going down to that level of support again, you start going, if your emotions aren't in check, you start going, well, it's starting to move against me, I need to sell it. Well, no, you don't need to sell it. You need to hold it. And the reason why you need to hold it is because you have to see whether it bounces off of that support line again. If it bounces off of the support line again, then you're good to go. You're in a good position because it's maintaining support. And then eventually there'll be enough people who either get on and push it up and buy in and push the stock value up, or it will break through that support line. Once it breaks through support line, now it's actually moving against you. And so then you use just a rule. You say, okay, it's broken through support, so I'm going to go ahead and step out. At least that's the method that I'm using at the moment, and I'll use it until somebody teaches me a better method. But it is the reason why, even though I've had multiple purchases go against me, I'm still way up as far as money is concerned, and way up. I'm 10% up over what I started with recently. So but I'm using that hard, fast rule, and I'm buying in so close to support that once it breaks through support, I'm going, okay, well, in other words, the big boy decided he's not going to support it at that line any longer. Otherwise,
Hey, Jimmy.
Yeah, go ahead.
Okay, this is Robert. I'm sorry to bother you. What you're talking about right now? What you're talking about right now? I'm looking at Jimmy's screen. Is there any way that you can show us exactly how to set your buyout point using this? I mean, what's your sell point or whatever, your loss point? Because I'm having a little trouble with that. Does that make sense?
So we're going to only focus on VLO just for this reason, okay? Because there's a couple of different ways, Robert, that I think that you can do it. But in regards to VLO, until VLO does something different, and we're only going to talk about how you would do it on VLO and every stock that behaves just like it. Stocks that tend to bounce off their 20 and their 10-day moving average, okay? Or 50, it could be the 50, all right? So I've dropped a line, this white line that's running across my screen. I'm on the minute chart now, but if I bounce back to the daily chart, the daily chart, you can see that that line is right there at my 20-day moving average. So this is both my buy.
Use as your daily.
Yeah, well, both the daily and the hourly or the minute. The daily and the minute, I think, are your two biggest ones. Okay. All of them are tools, but the daily and the minute, I think, are the most ones that you use. So I've dropped a line here to see where it is. So that way, when I roll over to my minute, I can see that line here. Now, I know there's some separation there. That's just how the software works. But all you have to do is get close. This becomes both my buy point. Hey, I bounced off of it. I'm coming back up. I'm going to wait for it to breathe. I'm buying in here. But what if instead of continuing the uptrend like you see on my screen, what if it kind of meandered up a little bit and then it turned and it came back down and it got close to right where the confirmation or the support line is? If that's what he's saying, that is your sellout point. If it dips below it, okay, and in this case, you see right here, it did go below it. It actually went below it. It hung out there for only 3 minutes. Well, I can't unload the stock in 3 minutes. But this is my point. At that point, I'm pulling up E-option. I'm going to the trade screen, okay? I'm putting in an order, and then I go back and peek at it one more time to see if it's still below my point. At this point, you would have seen that it instantly came back up. So you would have went, okay, I'm waiting. But once it goes below that screen, that's it. You get out. You get out right then and you don't look back. It's okay. Cut your losses. Save your losses. That's what he's saying.
So you're not really looking at any numbers. You're just kind of looking at the line, pretty much.
Right. That's exactly right. You're looking at the line. Because if you would have got out right here, let's say you pulled the trigger at this point, you'd have maybe only lost 20 cents on the dollar. Okay? So in a contract, you'd have lost $20 off of this. That's all you would have lost. You would have waited. You'd have seen it come back up. You went, okay, it went back up. All right, well, let me watch it again. It came all the way back down, got close. You went, well, it's back at a buy-in point. So you buy a few minutes later. Okay, it goes up for the rest of the day. Now you made $1. Well, now you just made $100. You lost $20 the first time. You made $100 the second time. Guess what? You netted $80. Now, I need to back up a moment because you can't really do that with the financial situation that you're in on your account. E-option and any of them, and by the same token, do not allow you to day trade unless you have a certain capital investment in your account, and you don't. You have less than $1,000. I have $1,500. Tanner, correct me if I'm wrong, but I believe you need to have $25,000 in your account before they allow you to day trade, meaning I can go in and out on the same stock multiple times in a single day.
Wow. But they still have limitations. And the limitations are just based on however big your account is. So, for example, you have fewer limitations if you have 50, but the minimum is 25.
So for you, and probably most everybody listening to this particular episode right now, what you're going to do if you got out and it goes back up, well, you just wait till the next day. You just wait till the next day.
Yeah.
That way you don't
they
get in
have
trouble.
Good faith rules. That's right. They have good faith rules where they'll start throwing limitations on what you can buy and when you can buy it. And we don't want any limitations on it on your account, and so you want to avoid getting in and out, in and out, in and out. So. Now you can, let's say, for example, this is what I did the other day. I got into a stock, and then the next day I got out of it, and later on in the afternoon I bought it back. But I held the initial stock through a nighttime period, so that's not considered day trading, even though I sold the same stock and bought it back.
All right, so let's go to this particular situation then as a scenario. Let's say he got out at that first point. It dipped below its line. He hits the button on E option. He's out. 20 minutes later, he sees it come back up above. He's like, okay, hang on a minute. He gets confirmation. It bounces off a support line. It goes up. He waits for it to breathe. He can go back in it. But at that point, he's got to hold it for the remainder of the day, correct?
That's correct. Yep.
Okay.
He has to hold it for the remainder of the day. Technically, no, he doesn't have to hold it for the remainder of the day unless they flag your account. They'll tell you. They will tell you on your trading account whether you have to hold it or not. And they'll do that before you actually buy it. It'll come up as a warning flag on your screen. Because you can have up to 5-day trades in a 5-day period and not break the day trading rules.
I didn't know that.
But you don't really want to toy with that. You want to stay away from that, because once you start getting close on that, the rules they're there, but they can exercise. They can pretty much make a decision for you. And you don't want to lose control over your account by doing that. So the best thing, this is the technique that I've been using since the trades have been so short. I've been using pretty much a rule of thumb that I try to buy in of an afternoon, and then if I want to get out of something, I get out of it the next day. And the only time that I don't do that is if it's really going against me. So that's just the rule of thumb. And then once you have the $25,000 in your account, then you don't have to watch that as closely. And all it really is even though you see the money disappear out of your account when you buy something, E-option and the clearinghouse, because there's a whole other party involved, they take the capital and they actually set on your money. And they may not actually pay for what you bought for another day until it closes business the following day. And so if you're getting in and out, there's a whole lot of capital tied up in that holding, in a holding account, that hasn't yet been paid to them or been paid out by them. And so they put limitations on what you're able to do with your account. And I have even met a gentleman that got his account completely frozen where he wasn't able to trade at all. So you want to avoid it. You want to avoid getting in and out of the same stock on the same day, if at all possible. So I know people are learning. So we
have some.
Go ahead.
Go ahead. Well, we have some questions on the chat that I was going to read to you. So.
Oh, okay, cool.
But continue your train of thought. I'm sorry. I thought I was going to jump in at a good point, and it was a bad point.
I'm sorry. I can just keep talking for a long time. You know that. So,
for anybody that doesn't know it, Tanner's has a intimate relationship with the female side of his brain, he can talk forever. When him and my wife get in the same room, I just leave.
Yeah, that's part of my handicap, I guess. Not no offense, but the biggest thing while you're learning is don't lose money. That's the biggest thing because you're learning, and so keep your losses as small as you can possibly keep them, so that when you get into a good trade and you followed all the rules and you've learned the technicalities of getting into it and the proper way of getting out, you make good money on those kinds of trades. But in this early time period, you may make a lot of mistakes. So just keep your losses as small as you can possibly keep them. And I know that's everybody's goal, so, I'm just saying that don't get tied in. Don't do what I have done in the past, and that is get into a stock without knowing when I'm going to get out, if it goes against me.
And if it does, you just, oh well.
Cut your losses. Cut your losses. Step out. The worst thing that can happen is it can go up from where you got out of it if you were in an up play, and you go, well, I could have made part of that money back. Well, you can't trade on coulda, shoulda, would. You just can't. You have to have hard, fast rules and keep them.
All right, I got a couple questions.
Okay, cool.
Yeah, somebody says, what made you decide on VLO as opposed to another stock?
Well, for me, the reason why I chose VLO is just simply because of how predictable, repeatable, and reliable it is. And the fact is that it has shown tremendous strength by not going below its 20-day, even on a day when the whole entire market, for the most part, went down. It has held its own against that, and also because it has a very, very short cycle. We're not looking at a trade that may take 3 or 4 days in order to move up, or 3 or 4 days in order to move down. It's more like a day or two. At times it's shorter than a day or two. And so the learning curve on it may not take as long for us to illustrate and to teach proper buying and selling points by using this stock. We may be able to have another time of learning or of teaching within just a couple of days. And so it is so that if you can learn the proper buy and sell techniques on a short moving stock like this, you can use those same exact buying and selling techniques on a stock that takes, a week to move from support to resistance. And that's the reason. So.
Okay. I had a user number 283 that says he's in the Philippines and he's got a bad connections. Let's see if I understand this. I want to set a get out limit, but the limits are in the price of the option, not the stock. How do we calculate this price? Okay, so I think he's asking about placing a limit order to get out. You're getting out of the stock and you're placing a limit order. Can you give us some general rules of thumb? Because I know I've sat there, I want out. I'd hate to do a market order because I don't know what they're going to give me. So I'm trying to do a limit order to regulate, my losses. Can you give us a rule of thumb there on setting a limit order, both to get in and to get out?
Well, if you're buying into an option, your best rule of thumb, of course, you got to get inside the spread. Because if you're outside the spread, they won't give it to you on a limit order, probably no matter what.
Define what you mean by the spread. Define what you mean by the spread.
The difference between the bid and the ask. So you have to get in between that. You really don't want to put it let's say that the bid, for example, is like $390 and the ask is $340. And you're buying. So what do we do when we want to buy something? We want to pay the least amount possible, right? So we would use the $340 and we would add, say, 20 cents to that price for a limit order. And then we would go through the process and hit place order, and then you would set and you would wait to see if the market maker is willing to accept it. And by the way, e-option is actually negotiating with the market maker on your behalf, which is pretty neat, in order to get you that price. And as long as the stock isn't moving too far in the direction you're wanting it to go, they'll most likely accept it. Now, if the stock is moving really quickly in the direction you want it to go and you're trying to buy in, do a market order. And the reason why you do a market order is because you know for certain that you're going to get into that play. However, if the stock is moving really fast like that, you may want to wait for it to breathe. And there's only a few situations where you wouldn't want to wait for it to breathe, and that is if you're seeing really high movements in the price coupled with really high candles or really high volume, and you see that repeatedly over and over and over and over again, because it may not breathe for $2 or $3. But under a play like that, that's not really something that we would want to get into anyway, because it sounds more like a news play. Some news has come out that's moving the stock, and usually if you're trying to get into a play like that, you're just too late. Why? Because the buy point has already been exceeded. And you'll be chasing profits instead of being in front of them. Now, getting out of the stock, same thing. Place your limit order, but instead of using the ask as your measuring point, you use the bid. Why? Because you're selling something. And when you sell something, you want to get the most amount of money you can possibly get out of it, right? So you take your bid and you subtract 20 cents if the spread is wide enough. You subtract 20 cents off of it, and you go, okay, that's what I want to sell it for. And
What do you do in a situation where there's only like a nickel difference between the bid and the ask? If the spread's only a nickel or 10 cents, what do you do?
Okay, if you're buying, you put a limit order for that, and they will almost always take it.
Now, what I've noticed is you said that e-option is negotiating on your behalf with the actual market maker. Okay.
Yep.
And what I've noticed is for instance, I'll put in a bid for $315 to buy it, and I come back and he let me have it for $312. I was willing to pay $315, and you just charged me $3.12. So that's e-option. Actually did that for you.
Yes. And it doesn't sound significant now, but just wait until you're buying 100 contracts. That's significant.
Jesus, please let me get to the point I can buy 100 contracts of anything.
Yeah. So
all right.
it's in your interest. E-option is actually working on your behalf. It's not just a computer doing a computer thing. And that's why, especially if you put a limit order in, the limit order, it just takes more time, which is why if it's okay, let's say that you're in a trade, but it's going against you and you're wanting out. If it's moving against you and it's moving against you real strong, do a market order. Do a market order, because the prices are moving so fast that every single time you hit the refresh button in e-option to see what the new bid and the ask is, you're behind it.
Okay, but isn't there a risk, speaking on behalf of the person who's very, very new to this, isn't there a risk of, let's say the bid and the ask was 350 and 355, and I just put in a market order? What's to keep them from charging me 365, way over what it's going for? What's to keep me from being screwed?
Now, if you're buying, I wouldn't buy with market orders. I would buy with limit orders. If you're selling and the stock or the option that you are buying or trying to get rid of is moving against you, and you're chasing the market maker because the bid and the ask keep on going down on you so fast that once you get in and do the math and you put the limit order in and then you preview the order and then you place the order, it's already moved beyond your point, so you're outside of the range. So the risk, yes, you're taking a risk that the market maker is going to buy your stuff back at a price that you wouldn't want to pay. But I've actually chased the market maker before on a limit order to the tune of over $100 on an option price. So I lost an additional $100 because I didn't get market order, because the stock was moving against me so fast that there's no way that I could get in front of it. I just couldn't get in front of it.
Okay.
So had I hit market order to sell, I would have made an extra $100 or lost. Well, I would have preserved $100 worth of my capital by hitting market order, but instead I put limit order, and I put limit order, and every single time I hit refresh, the market had already moved the price beyond or lower than what my limit order was. And so I had to go through and edit, and then I'd do it again, and boom, it had already moved again lower than what my limit order was. He's not going to accept your limit order if it's not inside the spread. He's just not. So
I got another great question. This is not on the screen, but this is just as me. Let's talk about the intrinsic value rule and how that can be bent. Okay. So initially, we've got a video on the website that says, how to buy an option, and it talks about intrinsic value and how you want to be 50% of the actual option price. So in other words, for a scenario, let's say the actual price of the stock is $50. Okay. And the strike price that you're looking at is $55. Well, no, let's make it a call. That's what we've been doing. It's $45. So the actual price of the stock is $50. The strike price of the option that you're looking at is $45. That's a intrinsic value of $5. I now look at the price of the option, and that option is, say, $6. Well, $5 is way more than 50% of $6.
right.
Can I buy that option?
Sure, you can buy it, but you'll be paying a premium. Let's say because it's a $50 stock, typically $50 stocks will have, say, 45, 46, 47, 48, and that's up to the market maker on what options are available. But let's say that instead of getting in on a 45, let's say there's a 46, and at 46 your intrinsic value is $4. And so you're paying less for it, and so you may be able to buy more contracts. That's the whole point. You can get into it though if it's the only one that's available. By all means, get into it, or go look for a different play. But you'll be paying.
Okay, so the intrinsic value exists only to maximize your profit. That's it.
Absolutely.
Okay.
In other words, for example, I've looked at doing some stocks where in order for me to get the intrinsic value correct, I would have had to spend $3,700 on a contract. And even if the stock moved completely in my favor, I was only going to make like $600, $700, $800. Well, that's not a very good return on investment, but the option had been bid up. because people were all over it. There was no uncertainty left in it. So there was very minimal uncertainty left in it. And so I decided to walk away from that trade because why in the world would I risk $3,700 to make such a small amount of profit if it moved in the direction I wanted it to?
Right.
There's just no reason in doing that. Why not go find a different stock to play? I mean, if this is the home run stock you've been looking for your whole life, absolutely play it, even though the intrinsic value is so much. But the total price for an option, and I don't think we've covered this yet, Jimmy, so I'm going to cover it, is intrinsic value, which is the difference between the strike and the stock price, the actual stock price and the strike price. That's your intrinsic value. So the cost of an option includes the intrinsic value plus time value plus volatility.
Okay.
The only
Now
thing
we have no control over volatility. That's something that's determined by the market maker. Time value we do have the ability to control because I don't have to get in it or not if it's too short of a time, right?
That's exactly right. That's the reason why we look for an option that is 4 months, or at the very least 2 months. I wouldn't. Every once in a while, well, I'll look at a stock and you got a choice between a 2 month expiration and a 5 month expiration. And so instead of going all the way out to 5 months, I'll go, okay, well, I've got the full 2 months, so I'm going to go ahead and play it. But if you notice, you run a risk on doing that because the market maker is the one that controls the time value and the volatility. He's the one who's in control of that. Intrinsic value is something you can actually sit down and do math on. So let's take the example you used. It's $6 for this option that has an intrinsic value of $5. Okay? That means that time and volatility is only calculated to be $1. So you would think that if, let's say, for example, the stock went to $51, you would actually gain a whole dollar in intrinsic value, correct?
Right.
That's what you would think, and you would actually add that dollar to the value of the option. You'd say that, well, now my option's going to be worth $7. No, unfortunately, that's not how it works. The market maker will decide, okay, well, time value and volatility was $1, so now I'm going to make time value and volatility equal $1.50. So you actually only had an increase of 50 cents.
I don't like the market maker.
That's right. Well, yeah, and unfortunately, there's no way to get around him. He's the man in the middle. So, but he's increasing the value only by 50 cents, even though it moved $1. Now, it doesn't always work that way. Sometimes it works in your favor. The whole idea is to buy the right option so that you take the majority of the power out of the market maker's hand.
Okay, I got
and
you.
How best can you do that? Buy a less expensive option.
Right, which is another reason we're looking at VLO, because it's a $50, $52 stock.
That's exactly right.
That puts our options in the beginning price point of around $3 to $3.50. So now I got a question from Tom. He actually sent me a text message. Tom, I'd like for you to go ahead and clarify what it is that you're asking. Meanwhile, brother, if you could, Tanner, pull up your e-option accounts and pull up VLO like you're going to buy it. Let's talk about what we might do tomorrow. I think that's what he's going to ask.
I might not be able to do that because I might be feedback.
I do hear feedback.
Yeah. My biggest question is if we're looking at VLO and we're looking at kind of how we're talking about how we would buy it, can we just look at it as it sits right now and make some decisions? Let's say that we were going to buy first thing in the morning, and or after playtime, and then so I'm just saying, if we were looking at it today, can we just look at what our options would be and kind of walk through the steps?
Yeah, if the market was live right now, we were not after hours, okay? And I'm looking at it, I'm thinking getting in. So if everybody else wants to do this too, go into your e-option account or whatever trading account that you're looking for. Put in VLO as the option symbol. Do calls only. Do near the money. And you want to look at a March 14 expiration date. And the only reason I'm saying that is because the dates available for VLO are January, February, March, June, and September. Well, March puts it close enough in the middle, so that's the one we're looking for.
And we're not looking to hold it for 2 or 3 weeks.
Exactly. We're going to hold it 24 hours. So that's the way it seems to be working. So, all right. So if you pull that up, what you'll see is the very first one that's in the money, which are in an E-option, or the highlighted rows in gray. The rows in white are out of the money. We don't consider those at all. Okay. We will later, but that's a top secret technique for advanced investing. I'll just a little sneak peek for you. Okay, so the first one that we're looking at is $50. Well, what's my current price of the stock? I look at the last price on my screen. I see it's $51.25. So that right there tells me I got $1.25 in intrinsic value. What's the price of the option? Well, the bid is $3.10, the ask is $3.20, and the last one that was purchased was $3.15. So I can take it to the bank that I can probably put in an order right now for $3.15 on a limit order, and they're going to take it because they just took it on the last order, okay? And I'm in between that. That's as it sits right now. If this was actually in a live trading scenario, it may say the bid $3.10, the ask $3.20, and the last of $3.05. Well, I can't use that, okay, because it was purchased too long ago, apparently. So I would put in a limit order for $3.15. And that meets my intrinsic value of being in that 50% ratio, or close to it, $3.25. $3 would intrinsic value would be $3.50 if you want perfect 50%. But as long as we can get, Tanner, 40% or higher, we should be fairly good.
Yeah, and actually I wouldn't buy the 50 at all. And the reason why is because I go back to my stock chart and I say, well, where is my sellout point if it goes against it? Well, it's $50.50 or somewhere thereabouts, right?
You may go out of the money so fast.
That's exactly right. And you don't want to go out of the money, because guess who has all the control once you're out of the money? The market maker.
So would you consider the strike price of $49?
Let me take a look at it real quick. $49 gives me $2.25 intrinsic value. $2.25, yes. That would be the one that I would grab.
Okay.
In fact, that's the one that I grabbed yesterday.
Okay. So I don't want to dismiss.
Even though it's over the 50, the other option, because of the fact that it's so close to my support line, I'm not going to do it no matter what it looks like. Because if it goes against me, I've got to be Johnny on the spot, because take a look at the difference between 50, and I know that they don't have a 51. That's how the market maker broke this down. But once you get past 50, you go to 55. And this isn't the greatest example, so I apologize about that. But once you go out of the money, you have no intrinsic value, which means the only thing that's left is the time value and volatility. And who has complete and total control over that? The market
The market
maker.
maker.
You don't have any control over it. So you never want to be out of the money. You want to be in the money. That way you have some say over the value, or actually the stock value has some say over the value of your trade. So I would get into the 49, even though the intrinsic value is $2.25. Which is more than half, it's still the better option for me to look at. And now you might say, okay, well, take a look over here at this delta. The delta is one of the calculations that says how much of every dollar they're quote unquote going to add to the value of your option. So you might say, well, the higher the delta, that means that they're going to add that much more of a dollar. So for every dollar, let's look at the $39 strike price. For every dollar of movement, they're going to add 98 cents. Well, okay, that's great. But look at how much you're going to have to pay for that. So you may be able to only buy one contract up here at the $39 strike price, but you would be able to buy 3 or 4 contracts for pretty close to the same amount of money at the $49 strike price. So you're getting
Okay,
the benefit.
I have a question.
Okay.
I have a question. Sorry. But you and I were having this conversation on the Delta, and I thought, because you just said it was 98 cents on the dollar for that particular one, I thought what that Delta was, if I remember previous conversation, is that I was supposed to take that number and multiply that by the price that I pay for the option, and that tells me how much I'm going to gain for each dollar of movement in the stock.
No. That is, well, okay. Don't multiply it times how much you paid for it, for the option. Multiply it times $1. So for every dollar of intrinsic value you gain, that's how much your option will go up. For example, let's just use the 50 because it's easy. It's a nice round number. Let's say you didn't get in at the $3.15 mark, and it moves in your favor, so it goes from this point, from 51.25, an entire dollar. 50, it goes up to 52.25. So
Okay.
So the computer is going to move the bid and the ask by 60 cents for that dollar. Okay. Now, that doesn't mean that you're going to automatically get 60 cents. And the reason why is because of the human element when it comes to buying and selling options.
Okay.
In other words, if somebody decides that they want to sell and they're really desperate to sell, well, humans getting on their computer and going, well, I'm willing to sell that for $3.10. Even though it's moved up, now, sure, e-option will come up and go, hey, or whatever trading account they have will come up and go, well, that's outside of the bid and ask. Well, let's say that somebody's getting in really, they're only getting in at the ask for their sale. Well, now the ask becomes the new bid and it moves it down. And it moves your option, your actual money down by $10 in this scenario.
Okay, so as I look at the delta, I can roughly say that's cents. Those are dollars. So if I had a delta of 0.500 for each dollar of movement in the stock, I'm probably going to gain roughly 50 cents on my option.
That's exactly right. 50 cents.
Okay, then I gave out bad information to a couple of people, and if you're listening, I'm sorry. It's Tanner's fault.
I apologize. There's so many different facets to this, which is why I'm saying everybody is learning, so keep as much money as you can by buying well, and if it goes past you, goes south of you, get out. so that you can learn it all, because this is one of those things where you don't actually have to know it in order to trade options. I was just teaching it, and the reason why I was teaching it is because some people would say, well, look at this one up here. If I just was willing to pay more for the option, it goes up a whole $1 for every dollar. Well, yeah, but look how much you had to pay for it.
Well, that's fine. If I got $30,000 to drop in it, I might do something like that, right?
Yeah, but why would you? Why not buy right? And
that's true, because instead of paying $13.80, which only gives me 35 cents more, I can actually buy 4 more contracts at the strike price of $50.
That's exactly right.
I can buy 4 more contracts.
So let's go ahead and do the math. For the dollar movement, up here, because even you have a delta of $1, for a dollar movement, you made $100 on that. But down here, you have 4 contracts for the same amount of money.
$1,380. We'll pretend like it's the bid. So you'd have paid $1,380 for the strike price of $37. To get that $1 movement.
That's exactly right. For every dollar the stock moves, you get $1. Okay, so you made $100 potentially off of that one trade. Now let's go down here and buy the same number of contracts for the money. So you're able to buy 4. Let's say 4 contracts down here. Well,
now
every dollar,
let's say I had let's say I had the $13.80. So $1,380. I can buy 9 contracts at the one for $310, can I?
13. If you're 1,300, no, you can buy 4 though. Because 1,300, 4 times the 310 would be $1,240.
12. Okay, so yeah, I'm sorry. You can buy 4. My math
but you
is
can buy
horrible.
4. So you got 4 contracts down here, but you only get 60 cents out of every dollar movement. But you got 4 contracts. So off of the same amount of money invested, you made $240 instead of $100.
Why do they even offer them then? Are people stupid?
Well, because they probably bought them or issued them a while back when VLO was at $40, or you only got to go 3 months back.
Yeah, I see what you're saying. So back in the good old days, whenever you could hold on to an option for 2 weeks straight,
right?
Actually. You might have actually started at $3 and now it's worth $13.80. You made a whole lot of money.
Whole lot of money. That's right. And because you were holding options instead of trading options, you made a tremendous amount of money. Which makes sense given where you started at. So I mean, we're trading options, so the whole idea is to get the most bang for your buck. So out of that same $1,300, or pretty close to $1,300, I would have made $240 out of a $1 movement down here at the $50 strike price. I would have only made $100. So your rate of return for that is only 13, or hold on. It's less than 10% on the most expensive, on the more expensive ones. But down here, your rate of return is what, 25% or more? So there's a reason why we buy these particular options. That's the reason why we've taught in the classes. Take a look, get your intrinsic value where you need it to be, and that's how you buy it. Because you may be able to buy 4 or 5 contracts instead of buying the more expensive one and get a whole lot more bang for your buck. So,
all right. So we plan on, for the near term, and like VLO could go change directions and do something stupid to us tomorrow, and we have to go look for another stock. But one of the things that I want to point out to everybody is, well, why can't you go find another stock that does exactly what VLO does for say $20? I can. I do. It's on my list. I got 5 of them. They do the exact same thing, which means the options on those are about $1.50. Well,
Yep.
why do we not go do that? There's a magic number of $50. You were telling me.
Yes.
Explain that.
$50 is a psychological number. It's a good round number, which means that it gets put on a whole lot of people's lists because it's at $50. Whereas some people don't even look at smaller price stocks, which means that they don't get looked at by everybody. But pretty much everybody's limit is the $50 price tag. Not only that, there's a whole lot of psychology behind the $50 number. People are weird when it comes to numbers. For example, let's go back and use your wedge on the S&P. There is a reason why it's decided to flatten out at $1,850. It's a nice round number. There's a reason why it's only gone above it once or twice. Because people pick numbers out of their head. I can give you an example. An associate of mine said that he got burned the last time that there was a bear market. So he's been in. He lost about 40% of his retirement in the last bear market. So he's been in since the last bear market, and he's finally made all of his money back after all of this time. And then he said, I'm not going to get burned again by another bear market. So I picked a number and said, if the stock market goes up to this number, I'm going to start pulling my assets out of retirement and moving them over to something safer. And the nice round number he picked was 100. He said it was 100 more points than what the previous high was before the bear market began. And I don't know whether that's entirely accurate because I hadn't taken a look just to find out. But he picked $1,850. Well, it's a nice round number. Not as round as, say, 2,000. 2,000 is going to be an interesting number when and if we ever get there. In particular, VLO, the $50, and we can go back to that. I'm sorry, I'm chasing rabbits, but the $50 mark also provides a level of stability that smaller valued stocks don't get. And the reason why is because of what I already referred to, the fact that it goes on a whole lot of people's watch list when it hits $50. So,
okay.
But that's why we've chosen it. The higher price stocks typically provide better returns on your money as well, because if you take a look at this range from the top to the bottom, you're looking at potentially close to $4 move. Whereas your smaller stocks, you may only be looking at $1 movement. And a dollar movement, you have to start asking yourself, well, is a dollar movement worth the risk? And sometimes it is. Depends on how nice that stock looks on your screen, and how much that option costs.
Let's look at one just to kind of illustrate what he's saying. Here's another stock that does exactly what VLO's been doing. This is one of those ones that bounces off its 10, and when it breaks through its 10, does bounce off the 20. And that is ETFC Echo Tango Foxtrot Charlie. This is E-Trade Financial Corp. Everybody knows who those guys are. This is a $21.50, $21 stock. The movement on that is only 50 cents. Yep. Now, if you get at the bottom, it could potentially ride up a long way, but look how far it's got to go if you're pulling this up on your own screen. If I look all the way back to the 31st of December, it opened around $19 or $19.40, and before it moved down was $21.09. It had to go 1, 2, 3, 4, 5, 6, 7, 8 days just to move $2. So that's not much movement. That's why we don't want to use those.
Yep.
I'd rather it move $2 in 24 hours or less.
Yep. Because it all goes into how that price is. There's a reason why the option is as inexpensive as it is, and that's because the market maker has set the volatility. Because the volatility level on that stock right there is really, really, really small.
Right.
Which means your risk is really, really, really small. But there's a risk-reward trade-off, and so you want to take risk, of course, limited by the rules that we've been teaching. You want to take the risk with the greatest potential reward. And that's why we're looking at Valero. And it, like you said, Jimmy, it may be something where we turn around and go tomorrow, oh my goodness, look at what it did. You know, now that we've talked about it all this time. I look at that stock and I go, well, it has tremendous stability. Pardon me. It has tremendous stability just simply because some big person does not want it to go below its 20-day. And that's fabulous, because if you take a look at other stocks that we've been looking at, myself in particular, I've been watching Triple D. Triple D was one of the stocks that was doing the same thing, riding its 10 and 20. And then over the last few days, it's completely broken its pattern. And so we'll need to watch and see if it establishes a new pattern or not before we play it again. So that's pretty much it.
Well, I'm going to give one last opportunity for anybody to ask any questions. Oh, I see Tom actually followed up with the whole when would we sell. So he says, so based on the $50 strike price, what would your sell point be? Well, don't base it off the $50 strike price, because we're not seriously going to consider that one. But we would consider the one for $49. Right now, we wouldn't buy the stock either. So if I pull it back up on the screen, I'm not going to buy it until I see it either bounce off the 20 or bounce off the 10. But let's say it just bounced off the 20. Okay? And the strike price at $49 still met our intrinsic value. What would my sell point be? My sell point would be the 20. Well, my get out, oh my God, it's going the wrong way, is the 20. When it dips down below that, I get out. Where do we get out if we're selling it for profit? Where do I draw my trend lines?
Well, I've got two sets of trend lines on mine. And the reason why is because when it goes up, it doesn't necessarily always make it to the top trend line. The top trend line would be the very, very top peaks.
And we've actually kind of changed our direction from a pretty steep climb to a very lazy roll. Yeah, more of a roll.
More of a roll. And so you have
so truthfully, we really don't have any trend lines to draw on the top for our most recent changes, do we?
Well, see, what you have to consider until it shows us that it's an actual roll, you have to use what I've got a second set of trend lines that takes the trough in between the highest peaks. There's a trough that begins on like the 16th of December, and it runs all the way through, and you can actually draw a straight line all the way through the 6th of January off of the tops of those candles, off the wicks, and you can use that as a resistance line. And if you take a look, it actually mirrors up with what it did on the 15th, and then what it did on the 21st. So that's a really strong line there. All right, so
okay, back up. Help me draw that one more time.
Okay. Start drawing your line on the 16th, the top of the wick on the 16th of December, and then just drag it all the way through the top of the wick on
December
21st. Yes.
Through the 21st of December.
January. Actually, no, January.
Okay.
That is the best trend line. And the reason why I use it is because look at how many points it hits the top of. It's the 21st, it hits, let's see here, if I can bring it up. It's the 15th, it hits the 6th. And then it hits that trough right in there where it just back and forth the whole entire time between the 16th and essentially the 26th of December. And then you can go back and even check to see how strong it is. You can go back all the way into November and see that it's picking up lines all the way back into there.
Okay.
And so that's how I would draw that. So your get out point, if it moved in your favor, let me throw crosshairs up here and move it to the next day. Your get out point would be $53 and about 53 cents. Now, I wouldn't expect it to go to the 53 cents. The reason why is because $53.50 is a nice round number, and we know that people like round numbers. So that would be my get out point on this stock at this moment in time. Because I'm going
what if it looks to slow momentum somewhere, but what if it's at 52.50? What if we actually do have a rolling stock, okay, and I can't get above 52.84, which is our most recent high back on the 21st? What if I can't get above that?
Sell it.
Okay.
Take your profit.
So that's where I would put my first. That would be my first sell for profit point is 52.84. But I watch it. If it carries momentum, my next stop is 53.30 roughly.
Yeah,
right?
Exactly. Yeah, that's what I would put. 53.30. And
or I'm sorry, 53. If it's tomorrow, it'd be 53.52 or something.
That's exactly right. And the thing is you look at that price, the 53.50 something, it actually hits the top of the highest candle. Back on the 13th.
Okay.
So that lends support to that. Because when people are deciding where to sell things, they not only look diagonally, but they look straight across. They look horizontally to see price points. And so
now, if you have less capital to invest, Robert Nix has about $800 that he can play with.
Right.
750. I talked to him today. Yeah, $750.
Right.
So he has less capital. Would you advise? Let me rephrase that. I got to be careful because we can't give advice yet until we're totally a nonprofit. But if this was you, would you tend to get out a little bit more conservatively to ensure that you maximize your profit and it doesn't turn south on you?
Yes. Again, how can you go wrong taking profits?
Right.
You can't go wrong taking profits. That's money in the bank. And
so the only hard, fast rule we have is to watch on this stock, watch our 10-day and our 20. If if 10 is our bottom, well, in this case it's our, well, we don't know yet. If it
Right.
was today, it would be our 20. If we go below 20, we get out.
That's right. Save your
Period.
money. Save your money. Yeah.
Okay.
And then later on, once we have more money to play with, we'll talk about some different stop-out rules that work. But for the moment, that is the rule. Just get out. Because you don't know what it's going to do once it goes past the 20. So once you're playing with more money, you have a whole lot more latitude to make different choices. And but for the moment, save your capital. Because, Jimmy, pull up Triple D. I'm going to go ahead and tell people about the trade that I did on Triple D.
Okay.
Let's see here. When did I get in? That would have been this. Tuesday, Wednesday, Thursday, Friday. Okay. I got into it on Friday, the 10th. Okay. I bought into it when it hit its 10-day moving average. I bought it exactly on the 10-day moving average. So I bought it at $93.18. And then look at what it did for the rest of the day. It moved in my favor, and I'm saying, yes. I'm going, this is great. Tomorrow's going to be a great day, or Monday's going to be a great day. Wow, I can't wait until Monday. Okay? So I figured it was going to go up here and go back to resistance. But instead, what happened on Monday was one of its competitors reported negative earnings, or potential negative earnings, because they hadn't actually broken their earnings report. They did an advisement early. So what ended up happening on Monday was it opened at the top of the candle body there. It actually moved up, and I'm going, yes, it's moving in my favor. And then that announcement happened by SSYF. And then it went down. So where do you think I sold today?
You should have sold it on the 10.
That's exactly where I sold it. Because if you can go back to the minute chart on that 13th day, and I know that there's limitations on how far you can go back on the minute chart, but if I was to be able to describe it to you, it actually went and bounced off the 10, and I'm going, yes, the 10 is going to be support. And then it went up, and then it come all the way back down, and it bounced off the 10 again, which is great. I'm going, yes, support's going to hold. My trade's still in good shape. It's still in good shape. And it went up, and it bounced on the 10 again, and it sat and meandered on the 10 for a few seconds. And then the next minute, somebody sold the bottom out of it. Okay? So it broke through the 10-day. I couldn't get the E option fast enough to sell it. In other words, I was doing everything I could possibly do to sell that thing before it moved any further against me. Okay? So your hard, fast rule is if it's moving against you, if it starts moving against you, get out. Get out. Save your money. Because once it pierced the 10, where was it going to go?
The 20.
It's going to the 20. What did it do that day? It went almost
It stopped
to
on the 20 and came back up. Yeah, it almost hit the 20 and it turned around and went back the other way. Well, at that point, you could have bought back in, correct?
I could have, because it bounced off of it, but I made the decision that I was not going to buy back in, and the reason why?
Because of the negative news.
Exactly, because of the bad news. Had it not been for the bad news, I probably would have bought back in. But I decided, the bad news, I don't know how this is going to play out, and it's a good thing I didn't, because take a look at the next day. The bad news affected it the next day. It opened, and it started heading towards its 50-day. Because if it breaks through the 20, it's probably going to go to the 50. Now, has it made it all the way to the 50s? No, it hadn't made it all the way to the 50s. So it's not actually behaving. It's the reason why I've walked away from the stock, is because now it's not behaving like it has in the past. So it's no longer predictable, reliable, and repeatable. So I've just walked away from it. And I won't take a look at it again until it becomes predictable, repeatable, and reliable. So,
all right, we look. I'm gonna look at one more stock real quick, and then we need to wrap this up.
sure.
Okay, just because it is behaving kind of like what the stocks we've been playing, and that's Google.
Okay.
So GOOG. This is an $1,160 stock. It routinely bounces off its 10, and when it doesn't, it does bounce off the 20. I love the way that its pattern is producing, but it's $1,160 stock. However, this is one that we can buy a broken contract on.
Mm-hmm.
But you're still talking $250 for 10 shares.
Yep.
Or for 10 options. And so because of that, we get more bang for a buck back on this $50 VLO.
That's exactly right. Because you remember how we were talking about that delta? Now, instead of multiplying the amount times 100, you're multiplying it only by 10.
Yep.
So you're not getting as much bang for your buck at all. And so we want to avoid broken contracts unless we're just in love with the stock and we have some money to throw around.
I don't have any money to throw around.
Eventually, they may have broken contracts on a lot of other stocks, but right now there's only five stocks that have broken contracts.
Hey, Jimmy, I got something since we can see your screen.
Okay.
Starbucks. Can you go there for a second?
S-Bucks.
Yep.
S-Bucks.
For the daily. And scroll out some. Okay. Oh, you don't have a 200-day.
I can put one on there.
All right. Yeah, throw one on there. Because I've seen that people were saying that this bounced off the 200. Okay. I wonder why mine's.
Well,
mine
when
is
you're
so
doing,
far away. Like my 200 days not
When-
even close to that candlestick.
remember, we want our average type to usually say exponential. You can also say simple, which changes it. See how that
Yeah.
changed it?
No,
And you can also go front weighted,
yeah.
and that's completely out of the trend.
I've changed everything. I've done different. And for some reason, my 200-day line is right around, like the point of it right now is $60.75. I don't know why.
$60.75?
Yeah, like it's my 150 days not even close to the candle.
That may require a phone call to Telechart. Let me tell you something. Telechart has a lot of heavy hitters that people with serious cash use this chart, which means in order to support people that are pretentious and full of themselves, they need to have great customer service. So don't hesitate to contact them and see if they can figure out why.
I've even taken it off and re-put. I mean, unless I'm doing the wrong average. I mean, I put on there moving average, and then I put it to exponential.
And then exponential.
I've stopped sharing my webcam because it said I was having network issues, so I'm kind of conserving my bandwidth now, but we're almost done.
It's really interesting, this stock, by the way, and I just want, and I know that it's not going to help you fix your problem, and I apologize, because that is something technical, because in all truth, it bounced off of its 200-day moving average.
Yeah, right at the open.
It opened above it and moved down to it and then bounced right back up. And this is one of those companies that you have to play it. You know how we put out a video about the kiss goodbye? You almost have to play it as a kiss goodbye over and over and over again. And the reason why is because the moving averages, especially the 10, 20, and the 50, are above the price and stuff. And so I would be extremely hesitant on doing up plays on a stock like this. Why? Because it's downtrending.
Yeah, I actually have a play in this right now. I'm gone against everything.
A put play, okay.
Yeah, I should have got out of it though today, but
Get into it.
What's today? Tuesday.
Today's Thursday.
Wouldn't you, Tanner?
I think so.
Okay.
Let's see.
That's here. What day was Tuesday?
21st, I think. Yeah. And I actually got in late Tuesday because I was at work and I wanted to get in at 74.70, and by the time I had hands free and got to my phone, it was well past that. Right. I jumped in anyways. I'm still in, but now I think I'm probably going to be screwed by tomorrow because of the earnings release. I don't know. I see a lot of people saying, yeah, and it's somewhat mixed, I guess. I don't know. I was trying to watch some of the after hours stuff, and now the app that you guys have, it's not that accurate, but it's showing it go both ways since closing. I mean, it was down 2 more points, and then now then it shot up almost 2. Right now, as it sits in the app, it says it's plus 81 and it's 74.20. So, but I mean.
Well, I will tell you that aftermarket, you can't really trust aftermarket numbers. There's a reason.
VLO did that because when VLO released it, I sent a shot to me and it was up like $2.50. And it shot my face.
Yeah.
But when it opened, it was nothing.
That's right. And the reason why is because there's a reason aftermarket or after-hours trading is not really the thing. And that's because you're pretty much tradable.
Yeah.
And you can pay extra money in order to trade after-hours with advisors.
Yeah.
But on particular stocks that you got in, and yes, it has moved against you, and yes, you held it to earnings, and so I wouldn't do that on a regular basis because
it's actually for me. It's been going down. I put it for it to go down.
And what did it want price?
Let's see. It's in the 73, higher 73 range.
You can actually go to your account and history.
Yeah, okay. It'll take me a second.
So it's actually moved in your favor.
Yeah.
And had you been able to see the actual 200-day moving average accurately, you would have seen it bounce off of it, and that's when I would have sold it today.
Right. Yeah, it was. I was watching it, and I was almost gonna do it right there after that huge drop in the morning, and people were saying that it had hit the 200-day, and I'm looking at mine, and I'm like, it's nowhere near the 200-day. What are they talking about?
Right.
So I just kept following it along, and yeah. So, and I even put in a 150-day to see if maybe they were confusing the two.
Bouncing off of it, yeah.
My 150 days is right around $70.
Greg, I got a question. Have you made money on it though?
As of close today, no. No, I think I'm down $5 because it came.
I wouldn't panic on it.
Shot
just
back
yet.
up.
I'd wait and see.
Yeah, no,
I'd wait and see what happens.
I'm super nervous just because of the aftermarket crap that I keep seeing, but I know it's not really legit. We can't go by it, but it still freaks me out because I don't want this thing to
Right.
open at $78 tomorrow. You know,
Right, exactly.
but
Okay,
Well-
so let me give you another rule that you can look at. Okay, when we're nowhere near moving day averages to use as support, when we don't really have great trend lines to draw off of it. Now, you can draw trend lines on this, but here's another rule that you can follow. If the option value devalues itself by 20%, sell it. So if I paid $5, if I paid $10 for it, since I'm horrible at math, if I paid $10 for it and it moves down to $9.80, I've lost 20% of my value. I'm selling it.
yeah. Well, I paid 420. I think it was as high as 480, and I think right now, if I remember correctly, when I logged out, it was $4.15 is what my account was showing.
So you got a little bit more room before you probably have to pull the trigger and eat it.
I'm gonna wait till after amateur hour tomorrow, and if it's going up, I'm just gonna bail. I think.
But
I don't know.
Well,
I think it's gonna go up a little.
when it comes to selling, I know that we say to wait for amateur hour to be over, but when it comes to selling on a stock that's going against you, it all depends. And like I said, if you got more money to play with, sometimes you would hold it longer. But if it's really going against you in the amateur hour, I might dump it. Even though it's in the middle of amateur hour, I wouldn't do it in the first 3 minutes.
Yeah, no. What I really mean, I guess, is I'll watch if it's super choppy and it's going up 50 cents and down $1 and back up $1. That's what I meant. I'll wait. But yeah, if it jumps out of the gate up $2 and then starts ticking up, I'll probably.
Yep, dump it.
Yeah.
Yeah. But it looks like you read the chart right and got in at the right time.
Yeah. I got in at I didn't get what I wanted to get because I charted it out. I set myself a buy point, and I was at work and I was making freaking meatballs. So my hands were dirty. I couldn't get. And by the time I finished meatballs and I got my hands washed, got my phone out, it had blown past my 74.70 buy point, and I'm like, oh crap. So I got it.
You better get that wife of yours on board, brother.
Yeah, that's true. I guess she probably. I don't know.
Get with the program, woman.
Yeah, and if it would have done 74.70, I probably would have been out of it that day because that was Tuesday, and it fell as low as 73.26 on that day, and that's what I did with VLO that first day we were in it. I took the higher end profits that day and said, I need that green right now.
Not a bad call.
But can't go wrong taking profit.
Yeah.
And we're going to learn that lesson for the future too. So I have less money to play with now. I'm going to take profit every single time I can.
I like that Starbucks breakdown there. That was pretty cool though, just to see the Head and Shoulders and.
Now Tanner may play some other stocks. Okay, I'm only going to play VLO until, like we said, the trend changes. We've seen this stock for so long. It seems to be stable in its movement. It's priced right and affordable. So I'm just going to play this one stock. This way I can devote all my attention to it. There's no question to it. I totally understand how it operates now until it breaks past its 20. If it ever breaks past its 20 day, I'm done. We're moving elsewhere because it's broke its trend.
Yep.
All right. Does anybody have anything else before we officially sign off here? You don't have to actually reply no, Dustin. All right, going once, going twice. Everybody be blessed. Really be blessed.
All right, have a good one.
we will talk to you guys when we talk to you.
Take care. See you, Tanner. See you, James.
All right. See you guys later.
Later, man.
All right. Bye-bye.